Welcome to Home Buyer's Money Map. This series is dedicated to demystifying the dollar signs on your journey to homeownership, and we will help you navigate your next home purchase. My name is Carol, your local real estate agent, here to guide you through the market. And with me, I got the Money Map mortgage expert, Damon Steele. He's from Pilot Mortgage Group, the co-founder of Pilot Mortgage Group. Hello, Damon.
Hi, nice to see you, Carol.
Hey. To start off, I just want to kind of answer a question I get quite a bit. Like, people don't really understand the difference between kind of like an independent mortgage broker or a bank specialist, mortgage specialist. Could you actually tell us a little bit kind of the difference between
Sure.
the two?
Yeah, I think the main difference is that for a mortgage specialist that works specifically for one bank, is that they're representing that one bank and offering you the product of that one bank. So it's not to say that they're any worse, it's just that they're limited by their product options that they have, and they're an employee of the bank. So when it comes to working with specifically clients that have different real estate goals, may not necessarily be the perfect fit for that bank policy. They're trying to push it into one option. With a mortgage broker, because we have access to a variety of different banks, credit unions, trust companies, different lenders that may have different policies, terms, maybe even more favorable options for clients, we can actually work with the client to figure out what their intentions and their goals are, and then tailor their mortgage specifically to the best lending fit for their needs.
You know, like a lot of things I do hear, people's like, oh, I'm lazy, I'm just gonna go with my bank. Potentially how much money they're kind of throwing away, or like perhaps in terms of terms and whatnot, you know, what are they missing out if they don't at least explore maybe a mortgage broker?
Yeah, so you know, one thing that a lot of people come to mortgage brokers expecting, they're like, oh, you know, I heard that you're going to be able to save me tons of money on my interest rate, and like, you know, that my realtor had mentioned that, like, you know, your interest rates are that much better. To be honest, banks are usually pretty competitive. They know that they're going to be competing against a wide variety of different lenders, different banks, different mortgage specialists, different brokers. And so what I try to tell clients is that it's going to be roughly the same. At the end of the day, you're probably going to be paying, you might be paying a similar interest rate from one lender to the next. The real concern and the question that we have is, if things were to change in your future, right? So like if you're, let's say, you know, you buy a home now, but you might intend to like sell that home in the future, what happens then? Are you with the best lender that's going to suit your financial goals, or are you possibly running into a big problem in the future that could have been avoided had we have had that discussion in advance and picked the right lender to get started? So to dispel any rumors, where we typically save people money in terms of like the cost side of things is actually all of the potential hurdles or roadblocks they may encounter in the future, not necessarily that it's going to be such a dramatic change in interest rate from what they might be able to get if they were to go, you know, from bank to bank to bank.
Yeah. Yeah, for sure. Like sometimes it's not just about saving money. Sometimes it's about saving headache and having just kind of like advisors by your side to kind of guide you through this. Like you said, banks, they're trying to help you for sure, but then they're also trying to make money only for that specific bank. So this is, I guess, personally, I do think that's the biggest difference. Okay, all right, so let's just dive into today's topic and tackle one of the biggest questions every person who wants to buy real estate actually have in mind. So the down payment part. How much should people put down? Because most people's like saying, oh, 5% is enough. Is that really enough? Is there a benefit to putting down more or putting down just 5%?
Yeah, it's a very nuanced question, and so one that we often will get asked, and I'll give you an example. If you're purchasing a property of $500,000 or less, you can put down as little as 5%. As you go up the price point, you kind of are limited. You do have to start increasing the amount or percentage of down payment that you're going to be applying. And there's certain advantages by putting more down that you might be able to take advantage of, right? So like if you've got access to 20% down payment, you might save some additional costs by doing that. But sometimes we've had clients that are like, well, I'm just going to wait until I've saved 20%. And if that's like in a few months from now, okay, reasonable. Let's work towards that. Let's start developing a plan. If we're talking years from now, well, what may have been a 20% down payment on a home today might only be 15 or 10% on that same home 4 years from now. So you still have to work within kind of your realistic goals. We also have to take into account, sure, you might be paying a little bit more by putting less money down and not having saved as much, but like you're not continuing to rent. If let's say, for instance, that's something that you're doing, so you're being able to like move your payments that you're paying towards your landlord into paying down a mortgage. And you're paying down a mortgage, your home value might be appreciating, hopefully is appreciating. And so if that's the case, then actually you're further ahead than if you had spent every waking moment of your day trying to scrimp and save every dollar that you could for the down payment. So the answer to this is nuanced. It's one of those things that let's just take a look at the situation. We'll often have clients that are like, they're just on the cusp. They've got like, if we pull everything together, there's like 18% there, right? And so we might say, if we were to talk with your parents, have a connection to see if they might be able to help you just get over the finish line, if it's minimal, like it's not a big, massive amount that we need to put towards it. If you were to do that, you'll save $12,000. Is this worth having that conversation? Is this worth waiting for? And I think that's the better way to explain it. So I don't want to discourage anyone who's thinking about, well, I only have 5% to put down. My bank told me that I should be saving more. My parents told me I should be saving more. Let's have a conversation. Let's look at everything first and then develop a plan for like what seems to make the most sense for you.
Yeah, absolutely. I feel like you do have to look at the whole picture and just in terms of that person's finance at the moment. If they're paying rent, if they're paying, for example, they're paying $3,000 rent and their mortgage may be $3,500, that $500, even though yes, you're paying more, but then you're putting down equity. You're actually putting money into your property instead of paying someone else. So it really depends on the situation. Of course, like sometimes the more money you can put down, the better. So that comes to kind of like insurance, because we know like under 20% there is a mortgage insurance. But even if you have over 20%, bank encourage you to have insurance. So explain the mortgage insurance part of it.
Yeah, great question. And this is one of those things that I've found over my career that a lot of people have not really understood. They've bought a home and they're like, there was this insurance, I don't know what it was. Was it home insurance? Was it fire insurance? And it's like, no. This particular insurance called mortgage default insurance. A lot of the time people might call it CMHC mortgage insurance. That's one of the bigger providers of this, but there are a number of others that provide this as well. Mortgage default insurance is a way in which a lender can protect themselves, not you as the borrower, but the lender, from any risk in the event you just stop making your mortgage payments. This is called default. And so if that were to happen, this mortgage insurance will pay out the lender in the event they have to sell your home and they suffer a loss. And it's a requirement of the government that lenders obtain this insurance if they're going to give you a mortgage that's going to exceed 80% of the property's value. So if you're going to, let's say, borrow up to 90% of the home's purchase price and put a 10% down payment, you're required to pay for mortgage insurance, as an example. There is a cost for this. Sometimes it's not necessarily as clear what those costs are because the costs are typically added into the mortgage. So usually when they're like, okay, you can buy this home, your payments will be this, in the fine print, it's this will also cost you $20,000, like the insurance that that you are paying for that's benefiting the lender. So this is the one that we're talking about. If, for instance, does it make sense for you to save a little bit more money and take a bit more time to be able to do 20% down or not? This is something for us to think about and see whether or not that's realistic. Now, the reason why this insurance is in place is that they're trying to basically, the Canadian government is trying to protect banks from getting stuck in a spot where all of a sudden property values decline, people stop making their mortgage payments, and all of a sudden all this money they've lent out isn't getting paid back. And so that's why they have these insurance products that exist to allow people to also enter into the market. It's a pretty expensive place, especially if we're talking Vancouver here, to be able to get in. And so the mortgage insurance is in place, and depending on how much money you're planning on putting down, it will impact how much you end up paying. So there's also a percentage, it's a premium that you pay, and the more that you put down, the lower that percentage becomes, and the less of a mortgage insurance premium that you'll pay.
If, say, people just go to the bank and then they just like give you the paper to sign, can you opt out if you're actually more than 20%? And if you opt out, what are the risks you're taking on if you don't take the mortgage insurance? Or is there elsewhere you can go to, or other insurance that could kind of supplement this?
Sure, yeah. So there's different providers of the insurance. So CMHC is one, another one's called Sagen, another one is called Canada Guarantee. So there's really 3 providers that provide it. The bank is the one that picks which one they want to use. They're pretty much all the same cost, so it's not like you pay a different premium from one or the next and they're going to force you to do that. They're all the same cost that you'd pay. Some of them have programs that are a little bit more tailored to specific types of people, like maybe if you're self-employed, there's certain programs that are more beneficial through like Sagen versus CMHC as an example. If you put 20% down, almost always you'll have the choice of selecting whether or not you want to pay for mortgage insurance or not. Most people will choose not to. Now, occasionally, the bank may offer you, or the lender may offer you, a slightly better interest rate if you took in mortgage insurance. So because it's protecting their interest, because it's reducing their risk, they're willing to extend that courtesy of like a lower rate to you by doing that. Now, that does come with other issues though. So for instance, the amount of time that you can spread your mortgage payments out over, if you put 20% down and take no insurance, is 30 years. If you take an insured mortgage, right, where you pay the insurance, you're only allowed to qualify that for over 25 years if the property's resale. They've recently changed some of the rules about that when it comes to purchasing a brand new home and your first-time home buyer. But generally, you're looking at having to pay over a shorter period of time, which is actually going to increase your payments. So if you're trying to keep your payments down as low as possible, it's best to try and extend your amortization, and if you can, try and have the 20% down payment requirement fulfilled and avoid the costs of the insurance.
Yeah, all right, so that brings back to the down payment part. So what have you seen people do in terms of trying to get kind of their down payment together? So we talked about maybe bank of mom and pops that we've been seeing more recent years, given that we're in Vancouver. So so what other things that you have seen that people actually utilize?
So I would say first off, the biggest one is mom and dad, because a lot of people, it's really hard. You're starting off your career. If you're renting somewhere else, rent's not cheap either. So it's like trying to save up enough money to be able to have a meaningful amount for a down payment on it is a lot of work. And so, and a lot of parents who have owned real estate here have been the benefactors of an increase in their property values. And so they understand that they kind of won the lottery to some extent, right? Having bought a place 20 years ago for 50 cents and, as far as the low price points that they had at that time. So a lot of the time parents are stepping in providing the down payment. And that can be from a lot of different ways. So like for instance, it could be giving them straight cash. They might be helping with co-signing. That's where the parents will also come onto your mortgage with you. So not so much just down payment support, but also their firepower of their incomes. If parents don't necessarily have the cash, what I've been helping clients with doing is talking to parents about being able to pull some of the money out of their home equity. So the property they already own that's worth so much more and they paid so much of the principal of the mortgage down, how can we pull some of that out and maybe pass an early inheritance on to their kids to help them over the finish line and be able to buy their first home? So that's like probably the biggest one that really exists in our market for helping people qualify for that. Now, in terms of like your own savings, like what you can do, there are for first-time homebuyers, and not only first-time homebuyers, but predominantly for first-time homebuyers, programs that will allow you to get some benefits tax-wise if you're planning to save money towards your first home. So the one, and probably the most recent one that we have, is the First Home Savings Account. First Home Savings Account, FHSA, it's a program that allows you to contribute up to $8,000 per year to a maximum of $40,000 in contributions. And that, whatever you put into that program, you can deduct against your income. So not to get into the nuance of tax, but basically
kind of like RSP, but
it's exactly like an RSP, but it's specifically for homes. And there's some, while the RSP plan is also something that you can use a little bit to your first home, it does need to be repaid, and I'll talk about that in a sec. But the First Home Savings Account, you don't have to repay it. It's basically just a really great thing. It's like a no-brainer type thing to take advantage of. So if you are thinking about buying your first home and you're deciding, do I contribute some money to my RSP? Do I put it to my First Home Savings Account? Absolutely, First Home Savings Account wins every time. And what you can also do is if you have money in an RSP and you still haven't bought a home, you can transfer some of that money out of your RSP into the First Home Savings Account and get the same benefits of it without having to pay it back.
Yeah, and the other benefit, I correct me if I'm wrong, I know that the First Time Home Savings Account, basically you can contribute $8,000 for 15 years. That goes towards your first home. That being said, if in 15 years circumstances have it that you cannot purchase this home, that goes back into the RSP. Yeah, I think that's a great benefit. So people should really actually start account. If not today, maybe like next year. Just think about it, because like if you start account today, for example, you can only put down like $1,000, which means that annual limit you still have $7,000. And that can be rolled over to next year. So essentially, the next year you'll have $8,000 plus $7,000. So you could potentially contribute about $15,000 into it, but that only gets rolled over 1 year, not beyond that.
Correct.
Yeah. All right, that is excellent advice. Thank you, Damon.
Thank you.
So the takeaway today is remember to calculate the minimum and the target down payment that you want to have, so then you can figure out kind of like a plan of how you could kind of afford your next home. And for those who are qualified and haven't opened a first-time home savings account, go and do it, because I think that can only benefit you financially. And speaking of planning, so next episode we are going to kind of unpack the stress tests, just to kind of figure out what is pre-approval, what is pre-qualifying, and if you get pre-approval, does that mean you will get the mortgage you want, you get to buy that house? So those are the things that we're going to talk about in the next episode. So thank you for tuning in. If you have any questions or any topic suggestions, feel free to leave them in the comment section for me. And if you are looking for help for home financing, contact Damon at Pilot Mortgage Group. Follow me so you don't miss the next episode. Until next time, stay tuned and have a good one.